Hello, I'm MaryAnn. Well, in a low interest rate world, you might feel like your portfolio is stuck in a rut, at least when it comes to its payout. Today I'm asking the question, how do you get your portfolio to pay you more? And to discuss the answer, I have Doug Warwick, Managing Director of TD Asset Management and Portfolio Manager of the TD Dividend Growth and TD Dividend Income Funds. Good to have you back, Doug. I find this an interesting question. If you have a portfolio of dividend-paying stocks, what do you do to increase its payout?
Well, it's really how you construct the portfolio. So what we look for are companies that pay dividends, and you know, the idea is you would avoid the real cyclical industries. So we try and focus ideally non-cyclical companies, but realistically less cyclical companies that aren't likely to cut their distribution. So there's a focus on the sectors that we're in, and then of course the companies within the sector to give us yields.
So you might avoid something like a technology stock?
Generally, we would avoid tech stocks. The price earnings multiples tend to be pretty high, and there tends not to be a yield with those stocks.
And stick to something a little more,
well,
like what?
Banks, pipelines, utilities.
Okay, all right. And let's look at what do you look for? Let's go down to the company level. What do you track and look for specifically in the companies?
Well, you know, the ideal situation for me is cash flow, and cash flow that grows over time, because you want your distributions to grow over time. So cash flow would be the big one. And generally, bigger blue chip companies that have shown some durability through business cycles and have survived lots of competition. Return on equity is important. You want to be in an industry and a company that returns well on the capital deployed. And of course, companies that pay dividends, and that's derived from cash flow.
So we have our portfolio of companies, and say we've gone through, and is there a magic number for how big of a dividend you might want, or do you just look for something that's going up?
Well, that can be a little tricky. You know, generally a dividend yield on a stock is highest before it's cut. So
that could be a problem then.
Yeah, you do have to be careful about that. And you know, if your stock price is sinking and therefore the yield is rising on a stock you own, what you'd want to do is really investigate that company closely, because the market is smelling something that maybe isn't right. So you could find that it's an opportunity that's misunderstood by the market, or you could agree with the market that perhaps there are some developments that are on the horizon which may lead to a dividend cut. But I think, you know, more importantly, what we look at, well, I mean, the absolute yield is important, but it's the payout ratio that's important. And so it really depends on the industry that you're in. So, for example, pipelines and utilities, largely regulated rate base earnings, and the growth comes through adding to that capital deployed through new pipeline projects or whatever.
So a lot of it has to go back in the ground.
Well, with pipelines and utilities, you're okay. So the payout ratios tend to be 60 to 70%. So that's fine. Banks, for example, also generally a lot of cash. Stated payout ratios for the Canadian banks are in the 45 to 55% range. They might have a little excess capital on top of that, which they've used to build their capital ratios, or perhaps buy back shares if they really don't have an immediate use for it. But getting to your question, energy companies, you know, the payout ratios are generally lower because, you know, the problem, you're depleting a resource as you draw it out of the ground, and unless you put money back into the ground, then your production will start to tail off. So you don't want too high a payout ratio on on an energy company.
Okay, so you have low in the energy, but pipelines, I guess the stuff's already in the ground, so they don't have to add any more into it, or is there a lot of maintenance there?
Well, it's pretty good in the early years. The maintenance gets heavier as the pipelines get older, but you know, generally that's pretty good, safe growth
area to go to. If you're looking for a dividend anyway, it's a nice payout for that. Let's look at Suncor. You brought, that's an example of an energy company. Why do you like that, and what does its dividend pattern look like?
Suncor is a great example. It's an integrated company, so they pull the energy out of the ground and refine it, sell it to the end consumer. And you've got a situation right now where prices at the retail level are based off the price of Brent oil, which is high. West Texas prices are lower, and the price in Western Canada is even lower versus West Texas. So, but they can pull the energy out of the ground and refine it and get very good prices for it. So as a result, Suncor is generating huge amounts of cash and has been increasing their dividend, paying special dividends, and also buying back shares. So that's a situation we really like.
And they seem to have a more focused management team as compared to other energy companies?
They're better than a lot of energy companies.
Okay. What about dividend? What does that look like right now?
Well, the yield isn't as high as a utility, but it's certainly growing. They seem to be increasing it once or twice a year, so that's nice. And the share buyback is also making a difference too. So
consistency, at least.
Yep.
All right. And the next area you brought for us was the banking sector, and that's, I know, been a long-time favorite of yours. How is that for dividends? Obviously, probably quite nice. What do you like about it?
Well, so the banks have high return on equity, high teens, and so each of the big five generates a lot of cash every year, and their payout ratios are between 45 and 55%, depending on the bank, and some of the banks even have share buyback programs. There was a bit of a pause in dividend increases after 2008 because the regulators changed the rules and required more capital. We're through that now. Capital levels are very high, which makes the banks even safer than they were. And so I would think, you know, at the level they're generating earnings and dividend growth, that banks are still pretty cheap at the multiples they're trading at right now.
Are they quite expensive, you don't think?
Canadian banks are 11.5 to 12.5 times, you know, this year's out into next year's earnings.
So not too bad when you look on a historical or a market average basis.
Right, and cheap relative to the broader market.
So would you say it's safe to say that if you had a dividend or a portfolio of dividend-paying companies, that it would be good to just go through it and make sure that you have those names that are either increasing their dividend or have a good, strong dividend, and that would be a way to increase your portfolio over time, after all?
Well, I believe that it's very important to grow the income on the portfolio over time, because I can't really control whether the market will pay 8 times earnings or 28 times earnings in any given year. But if we can buy companies that grow their distributions over time, at least you're getting that multiple on a much higher income over time. So, you know, I've been managing funds for TD for many years, and in the last 21 years, for example, the stocks I have in our funds have probably increased their distributions 5-fold at least. So, you know, that...
Good strategy to look at.
Exactly.
All right, thank you very much, Doug.
Thank you.
I've been joined by Doug Warwick, who's Managing Director at TD Asset Management. Thanks for watching.